The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
Well, good morning and welcome to The Trade. Let's get you across what traders are watching around the world. And Federal Reserve Bank of Minnesota President Neel Kashkari says it's too soon to know how short-term borrowing costs may need to be adjusted for U.S. President Donald Trump's tariffs and their expected impact on inflation and the economy. Meantime, U.S. Treasury Secretary Scott Bessent said that he believes there will be a de-escalation in U.S.-China trade tensions, but negotiations with Beijing have not yet started and will be a slog. That was according to some closed-door comments he made, apparently, at a JP Morgan conference. Tesla's Elon Musk says he will significantly cut back the time he devotes to the Trump administration from next month and spend more time running Tesla itself. Meantime, the U.S. wants to sell more energy and defense equipment to India to build closer ties. Vice President J.D. Vance has praised Prime Minister Narendra Modi repeatedly as talks over a trade deal progress. And the ECB could hit its 2% inflation target in the coming few months, but the broader economic outlook is far too uncertain for the bank to provide any meaningful guidance about its next policy move, according to an ECB policymaker. So with that backdrop in mind, let's get into the technicals with Jonathan Tacadena, who's joining me from MPC Markets. Nice to see you, Jonathan.
And thanks for having me again today.
Well, yesterday it was the Sell America trade,
Yep.
but boy, the brakes seem to have been put on that.
Yeah, exactly. So one day 1,000 down, next day 1,000 up. It just shows you the volatility that we're having at the moment, and the markets are always looking for certainty, and that's definitely not on the cards at the moment because Trump is kind of just firepower one day, he's my best mate next day. So that's basically what's happened.
Yeah, okay. So what does this mean, though, to the broader narrative about U.S. exceptionalism being over?
Yeah. Okay, so I don't think it's over per se, but I'm just going to highlight some risks. So I'm going to talk bigger picture today about basically what's happened in this great run is that the whole world is overly long U.S. markets at this stage. I think the stats are, and I have a chart there, is that basically it's about 75% now. So if you take the market cap of the whole global world stock markets, the US is about 75%. And the only time that's actually happened in the past is Japan back in the 80s. So it just shows you that pretty much everyone has invested in the US. And the great thing about the overseas investors is that they actually got a second wind as well. They got a 2-for-1 deal, meaning that when they invested in America, the US dollar was quite low, and what's happened is the dollar's actually risen along with the stock markets as well. So what's happened is, if you've invested in the US stock markets, for a long time, you've had a 2-for-1. Basically, the US dollar's increased, and the stock market has risen quite well. So basically, what's happened now is that everyone is in the same position. It's a very crowded trade, and I'm just starting to see some signs that it could be reversing here. And one of the things that we actually do at MPC Markets, we started off an ETF portfolio called ETF Elite. So that's an equity market cap. So that actually just shows you, how much the US has dominated the world economy. And kudos to them. Wall Street's done a great job. They've actually made all their markets very accessible. If I wanted to trade options, it's actually easier to open up an options trading account and trade US options than it is here in Australia. So it just shows you that, ASX thinks we have a monopoly on world markets. No, we don't. So basically, the US has just given investors a lot more options and a lot more accessibility, and that's why they've dominated the market. So Wall Street's done a great job there, but as we've seen in the past, is that it can't go on forever. Like, this trade isn't normal. We can't, US may be the biggest and best player, but we've seen that Donald Trump wants to bring some of that manufacturing back to US. He wants to make America great again. And to do that, he needs a lower US dollar. Like, if he wants to be a competitive exporter going forward, he does need a lower US dollar. And one of the scary things for overseas investors is that even though the stock market has fallen, what's actually happened is that we've seen signs that the US dollar has weakened as well. So we've seen the US dollar move down from roughly about 120 all the way down to under 100, and that's a weekly chart as well of the dollar index. So if this trend were to continue, it could go all the way down to 90. So let's just say the US stock market just goes sideways for a bit. If the US dollar goes down, all these overseas investors have that currency risk as well involved. So there's a lot of dangers involved, and that's kind of just what I'm highlighting. I'm not saying that the period of US being USA number one is all over, but everyone's had a really, really good ride. Everyone's had a really, really good trade in this. It could be time to take some chips off the table.
Yeah, there were some theories around yesterday that the reason we saw CBA take such a big leg up was that overseas money was finding a home in Australia.
Yep.
You can comment on that, but it wasn't an overarching positive for the Aussie market. And I was chatting with somebody earlier on today saying that we could actually just trade sideways here for quite some time. We could just sort of end the year at the 8,000 level. Is that how you see it?
Oh, well, look, I don't think markets stay still forever. So I think the only guarantee that we're going to see is going to be volatility going forward. So with the way Trump operates, he went for the shock and awe of the tariffs. Now he's starting to wind that back a little bit. If he backtracks even more, we could just see, basically that whole thing just blows over and we could see a massive rally again. But the last chart I do want to show you is kind of like that ratio chart that I brought up. So when we started off our ETF program, we actually put real money into it late December. And what this is an XJO to S&P ratio chart. So I started back in the markets back in 2001. And what happened there was basically it was a massive commodities boom. So you could actually just buy the Australian markets and it would outperform the US. GFC hit and that all reversed. So what's happened since 2008 is basically because of the money printers and the US dollar weakening, everyone piled into the US markets. And obviously they had AI, they had that innovation, and obviously it was what's the phrase? It was the cleanest shirt in the dirty laundry type of thing.
Okay.
So,
best house on the worst street.
Yeah, exactly. So that's what's happened. And we thought that if our benchmark was the XJO 200, we could easily beat that. One of the things that we thought was we could actually just invest in the US because it generally outperforms, and that's what that ratio chart was showing. But what's happened is since we've had this first bout of volatility, we've seen that the US has actually underperformed. So this is the first time we've seen in a long time where we've seen the Australian markets, the Asian markets, and the European markets outperform the US. Now, I'm not saying that this is the end of that trade and cash out of the US, but you can just see that Trump does want to. He's not missing his words. He does want to bring back manufacturing, and if that's the case, it just means that US has to take some pain in terms of what they've enjoyed so far. And that's being basically the reserve US dollar, cheap borrowing rates, and that seems to be all changing now.
Yeah. What is so interesting, I saw a chart earlier today saying manufacturing, good for America, but not for Americans. So this is the share of US respondents agreeing or disagreeing with the following statement on US manufacturing. So America would be better off if more Americans worked in manufacturing than they do today. Well, 47% say they somewhat agree, 33% strongly agree. But I would be better off if I worked in a factory instead of my current field of work. Well, guess what? 42% strongly disagree, 30% somewhat disagree. So they all want manufacturing to come back, but nobody wants to do the jobs.
Exactly right. I think there was that, I don't know if you've seen it, but there was a good troll of basically AI generated.
Yeah, I saw it.
So the Americans actually working in the factories and they're like, whoo.
Yeah.
Yeah, so China is the factory of the world, not by accident. They've secured all the supply chains. They've built massive infrastructure and secured basically all the resources as well. So it's not by accident, and they've got a great, strong workforce. And what they're doing is they're actually upskilling now. So what you're seeing is that they're not just making shirts anymore.
Mm-hmm. No,
they're talking electric vehicles.
Guess what? U.S. tech, the dominance of U.S. tech. Some are really calling it into question, particularly in this tariff environment. I mean, even Elon Musk today was saying that he's hoping to get an exemption for rare earths to use in his humanoid robots. Because the trade tensions will impact that part of the business. But anyways, we're going off piste. So thank you so much for joining us, Jonathan, putting things in perspective. As always, joining us from MPC Markets. Stay with us. Plenty more to come.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.